let's talk a little bit about the rental rates. Salt Lake County's been interesting. So Salt Lake County's seen an increase of 14.5% from the same time last year. It's exciting stuff. So a lot of that is driven by population growth. We're seeing a massive amount of population growth just across the valley. Salt Lake County seeing their own version of that. But what's cool about that is because it's now infill sites. Sites are more expensive to get into, which means there's not a lot of supply, and so the demand is a little higher, so they're pushing up the rental rates. I'm Mike Medina. I'm a retail investment broker. Mountain West just dropped its Q2 2025 market report. It has a few indicators that are really helpful for the Weber-Davis County investor or business owner. One of the first indicators you'll notice in that market report is vacancies risen. So just Weber-Davis County alone in the retail sector, we entered this year at 3.3% vacancy. It's up to 4.6%. I think one of the things I want to touch on is why the increase. So what we're saying is it's now becoming a little bit of a tenant's market, but I think it's bifurcated. There's existing retail, existing commercial real estate that they're able to be a lot more aggressive on rents and just deal structures alone, where new construction, it's a little bit more difficult to do that. You obviously, with new construction, it's a clear slate, you're able to get what you exactly want as a tenant. The challenge is, can it be done in an affordable way? Cost of construction, with it being so high, cost of land, it's very difficult to be able to structure deals that allow tenants to be successful. In commercial and retail, it's pretty simple. If a tenant is going to be able to perform well in sales, they're going to be able to pay rent. And when they're able to pay rent, everybody's happy. So the challenge is finding a lease structure that allows that tenant to be able to have a successful operation within the property. So our job is to find that. On a positive note, we've seen an increase in rent, which is really exciting. A lot of those drivers is because existing real estate is being filled. New construction has been a little bit more difficult to fill. So with vacancy increasing, which means we've got more supply out in the market, it's interesting to see that rates have increased as well. And I think a lot of that has to be driven by the deal structure, so there's probably more incentives to get the deals done. Also, the new construction. New construction, as it's getting absorbed, they generate more rent. They're tougher deals to make, but that usually kind of pushes up the average rent rate. Let's talk a little bit about new construction, specifically to that. So under construction today, what we've noticed is a drop from the same time last year down to 23%. Significant drop. Primary indicator on that is the cost of the land and cost to improve it. Very difficult in this market today. Yeah, so anything new construction, right? So a lot of what we're talking about right now is retail. So it's interesting with retail specifically, it all drives upon how well the stores do in terms of stores performance, right? So stores performance really dictates what they can actually pay in the marketplace, So it's exciting to see a few things happening, like with the Trader Joe's coming into the marketplace. We're seeing a lot of activity happening along Riverdale Road, but you'll notice there's not a lot of new construction. What they're doing is they're repurposing old boxes. But the market report indicates some of the things that are going on there, where if you're driving down, you're seeing construction, but you're really seeing that in multifamily, you're really seeing that, you'll see some in industrial, but in terms of retail commercial, not as much. Now, when we get into the smaller fast food restaurants, you got your In-N-Outs, you've got your Raising Cane's, those deals are a little bit different. Because they're high volume restaurants, they're looking to be in the marketplace. So if you look at Antelope Drive, if you look at Farmington Station or Station Park, you look at Ogden, 12th Street, Riverdale, you're gonna see your majors, and they're new buildings. Those are a lot of times being done by the actual tenant. So we're excited to see some of the growth happening in the market. We're seeing a lot of new brands coming to the market, which is really exciting. I think Utah's on the map, which is an opportunity for us to be able to go out and really liven up our retail corridors. In turn, gives more opportunity, more supply, I would say, what's the word I'm looking for? More amenities. The local residents have more amenities, more unique amenities, which is kind of exciting. Weber and Davis County have been a little late to the game. We've seen a lot of that in Utah County and Salt Lake County. So it is exciting to see that happening. But the market report really says a lot about what's trending. We're going to see vacancies increasing. Keep in mind, vacancies are increasing because of the absorption, right? So we're not seeing a massive amount of absorption, but we are seeing some new construction starts, but just not as much as we used to. Because of all of that and the compression, we're seeing those rental rates increasing. And as we get closer to the end of the year, we're going to see a lot of retailers, a lot of businesses looking at the market and saying, hey, we need to start preparing for our 2026 stores. So they're going to start hitting the market. We're going to see some of those leases starting to kind of come together. And I anticipate we're going to see a little bit of an uptick still in those rental rates. Will we see an uptick in vacancy? It's hard to say. It's hard to say. I think we'll see it stabilized. That's my initial reaction, but we'll find out.